Hello and welcome to this special edition of Newsmaker. I'm Latha Venkatesh. The news, in a bid to increase transparency in the market regulator SEBI has written a consultation paper wanting more disclosures from what it calls high-risk foreign portfolio investors. In this consultation paper, SEBI has proposed that FPIs with more than 50% stake in a single stock or group conglomerate will need to reveal all ownership details. These details have to be given within 6 months, or there is a chance of the FPI itself losing its registration. The move comes after SEBI told the Supreme Court appointed panel that it had, let me quote the SEBI again, drawn a blank or hit a wall in terms of identifying beneficial owners of some of the FPIs invested in the Adani group of stocks. This is with respect to the allegations made by the Hindenburg report. Now, we're discussing the SEBI consultation paper and whether it will be successful in getting all those granular details it wants, whether it will be successful in identifying whether some FPIs may be in cohorts with the promoters. Will it be able to succeed in all this? Joining me to discuss these questions are Deepak Shenoy, founder of Capitalmind, R.S. Loona, former SEBI ED and managing partner at Alliance Law, Vivek Mimani, the partner at Khaitan and Company, and Manendra Singh, partner at Economic Laws Practice. Gentlemen, thank you very much indeed for joining me. Let me start with you, Mr. Loona. Is SEBI in the right direction? This is where it ought to go if it is hitting a wall under PMLA and other rules to find the ultimate beneficiary owners.
Well, identification of beneficial owners of FPI investment has always been a concern of SEBI. And in the existing regulations, there are provisions for making the disclosures in respect to the beneficial owners. The present move is in the right direction because it is identifying the particularly high risk FPIs, which probably according to SEBI or the market insiders, they might have violated the minimum public shareholding norms or the press note number 3 of the government, whereby the investors from the border states of India, they could invest only through the government route. And there is apprehension that some of the investors in the FPIs which are investing here could be from that kind of countries.
Yeah, no, broadly, I get your broad drift. So you say the effort is in the right direction, no questioning that. Deepak Shenoy, just let me get the market point of view. SEBI has filtered out the sovereign wealth funds, the central banks, the government pension funds, widely held or widely invested in public funds. Do you think they have clearly minimized the risk to the market? Only 6% of FPIs. What's your reaction?
I think yes. I think Latha, the large, the fear was, would this apply to say an index fund that has India exposure or partial India exposure? They've eliminated all of those possibilities. They've even given time of 6 months after whenever this becomes a public thing that the numbers can be tweaked and brought down or adjusted. But I think here there is this risk that the 6% also could result in a fall in certain companies or because what they have to do is change their existing contracts with their customers, their investors, to allow SEBI to circumvent any privacy laws that allow them protection under their own home jurisdiction. So that is one thing that could be concerning to even a legitimate fund that by chance or for whatever reason holds these norms. Of course, I think I don't think it's going to be a huge impact, but only the market will tell us which companies are impacted.
Okay. Well, the fact that the market didn't react violently yesterday or today to the announcement seems to give the impression that this is not a disruptive announcement at least. But is there a verdict that it is not an effective announcement, that really this can be circumvented? Is that what we should take from the very calm reaction of the market? Well, that question to you, Vivek. Can you really get to the final beneficial owner from the rules that SEBI has said? Or is it always possible that you put a dummy as the final beneficial owner, but have a private agreement with him or her or it? You think this is a wild goose chase?
See, I think from a practical perspective, it is going to be seen how SEBI is going to implement this. So practically, it comes down to the implementation and whether it's a wild goose chase. From a market perspective, while we are saying it's 6% and going down the personal individuals, a lot also depends on the personal data and what investors are comfortable with. So the question comes, are we chasing investors from India? Because while you have a 50% threshold of a company, investments into a company, there's also a fact that if any FPI, which is in excess of 25,000 crores, that is also categorized as a high risk category, and there is certain you go down to the UBO, ultimate UBO. So practically, I mean, it's all going down from an implementation perspective. We have to see that, and when it comes to personal data, people are not comfortable sharing personal data. I mean, with the larger funds, some of them assuming they are not public funds, but to that extent, there is a risk which is there. And coming down to private arrangements, the question is that if somebody wants, practically under law, you cannot have private arrangements, but if somebody wants to violate, I mean, it will be a wild goose hunt for SEBI then.
Okay, so there is a little bit of loophole over there. But 25,000 crore, I would assume that there are not so many FPIs in that category. SEBI has not given subcategories. They are saying everybody who come in for high risk amount to only 2.6 lakh crore. Of this, 25,000 crore must be a very small number, isn't it?
See, that data is not mentioned in the, it's
Fair
not
enough.
mentioned in the paper. So
Fair
some discussion around that, if SEBI had mentioned, maybe we could add objectively to it.
All right, that would be perhaps the next question, if there is a SEBI press conference or any other way. But Manendra, see, Vivek is raising a doubt whether it could be disruptive, whether FPIs would be wary of giving their details. Hasn't SEBI made it a little above board? They're only looking for people who have, I mean, as they say in their observation, more than 50% of their AUM only in one group, and the position has remained static for a reasonable number of years, which gives the raise to the hunch that maybe the promoters and the funds are either the same people or in cohorts at least. They're persons acting in concert. Isn't the case built up reasonably well?
So I think how I look at this is the way the consultation paper is drafted and the rationale which have been given by SEBI is twofold. They're trying to capture the whole MPS norms breach. And second, if there's a PN3 violation that can possibly happen. And to understand that, I think it may be said that in the beginning, they are trying to only look at the high level, high risk FPIs. And it's going to be a very narrow list, which the SEBI is trying to figure out. And to answer your question, whether they've gone overboard or not, I think the intent is coming from those two reasons, that PN3 violation and MPS norms. I think it's a direction in the right step, because they want to make sure that, especially in the listed entities space, the decision making is lying with the real shareholders who are going to be controlling the affairs of the company. And somebody probably sitting out of India is not calling the shots in consonance with the promoters or the family groups of the promoters. And that's where they are clearly saying that if that is the situation, then it is not the true float which is being represented in a listed company, and which
exactly the free float. I mean, I think that is the big point that SEBI seems to be making, that we don't want that the free float in effect is 4, 5, 6, 7%. that, some 15-20%, which is actually held by FPIs, is perhaps in some way a proxy for the promoters. That seems to be the underlying message. Mr. Loona, what is your sense? Should the rules have been tighter? I mean, that is one way of looking at it. You have 6 months to bring down the stake. Now, if there is a fund which really wants to circumvent the rules, they can always create another new fund. New funds are given 6 months. So you could just pass on whatever is excess in your investment in one target company. Say, you have 70% of your money in one company. You take out 21%, put it in a new fund. And the new fund has the liberty to be exempt from the rules for 6 months. And then after 6 months, you create another. So do you think this 6 months is too loose?
I think let us understand that what is 6 months they're talking about. They're saying that the disclosure requirements, which are additional requirements, they are required to be complied with by these high risk FPIs after 6 months. The reason being that during this period, if they bring down the investments below the threshold limits of 50% in a company or group of companies or 25,000 crore overall investment, then in that case, they will not be required to comply with the additional disclosure requirements. In fact, it raises a doubt in my mind whether the intention or the purpose of the circular is going to be served by giving this kind of long ropeway to the FPIs to comply with this.
So you do think it's a long rope that they've given, too long?
I mean that with this you can probably take care of the future violations, but if the intention of the circular is to catch hold of the people who are already committing or who have committed this violation of the minimum
shareholding
public
norm,
shareholding requirement or press note number 3, then I think the period should be maximum 2 months or so, because otherwise within 6 months nobody will be available. Everybody will go scot-free.
Yes, sir.
And we should ensure that they are given. And I understand that we can't have the abrupt
change in law
offloading of this investments in the market, because that can also impact the script's valuation and can cause losses to the FPAs, which is not as per the government's policy of doing use of business and all that.
Now, Mr. Loona,
but the time should be a reasonable one.
You make a very important point that 2 months perhaps would be enough. And I want to put that to the vote of the rest of the panel in a minute after the break. Please think over that question. SEBI has put out a consultation paper asking that FPIs who are deeply invested in only one stock or group of stocks should give granular details as to who are their ultimate beneficial owners. We are discussing that paper with Deepak Shenoy, RS Loona, Vivek, Mimani and Manendra Singh. Well, before going to the break, Mr. Loona made the point that giving 6 months for people invested in just one stock overwhelmingly to come down to below 50% of their AUM is too long a rope and may result in the big fish slipping out of the net. Your take, Deepak. Do you think that that's really too long?
So I think, Latha, I would differ on one part. I think the 50% shareholding in one group, sure, give them 2 months. But somebody with just 25,000 crores invested in India, that's just $3 billion, has to also, comply with these norms, not just within 6 months, but any change in their investor structure, they have to inform SEBI within 7 days. I think this is very onerous because if you have a hedge fund or let's say a soft bank that is invested in some companies at an FPI level that eventually becomes a public company, or if they have some of these investments in a public company, they have to reveal all their investors, even if an investor sells their units in their fund and then somebody else buys it. I think that's a little stretch. This and 25,000 crores should be an upwardly adjusting figure.
Fair enough. I think both you and Mr. Loona should write to the SEBI because anyway, that's what they have put the consultation paper for by June 20th. But, I'll leave the press note 3 aside because that's a category by itself and the minimum public shareholding is another category. The minimum public shareholding is perhaps more likely to impact stocks. Therefore, Vivek, on that point, do you think that, if you gave these 6 months, first of all, it's a long period, and then there is a separate rule which says that this doesn't apply, this 50% shareholding exposure, disclosure norms doesn't apply to newly set up funds for a period of 6 months. Put together, is this a loophole that needs to be plugged?
No, Latha, I don't think it's a loophole because for any genuine fund to actually start operations, so if you look at the category which is not covered is a hedge fund. So for any genuine hedge fund to set up and start operations, you need to raise capital over a period of time. And the 6 months is something which you actually need to comply with, say, the 50% threshold to build your portfolio. So that is a reasonable time which is provided. Today, even if you look at the FPI regulations, SEBI gives you 2 years to actually ensure that the NRI criteria of 49%, 25% is met.
Sorry.
So this is the flexibility which should be provided. And
all right, you can't take out 6 months from the new fund. But what about Mr. Loona's point that why should you give people who are already over 50% in one stock?
For that,
you think that merits reduction to 2 months or whatever?
That definitely, I think, merits. You can look at that because it's already.
Deepak, do you stand on that?
Sorry, I think
reducing the already existing overwhelmingly invested funds to bring down their stake in one stock below 50%. Don't give them 6 months, give them just 2 months.
Yeah, I agree with that. I mean, I think having more than 50% in one stock or group it's astounding that a fund would do that. But so you
Fair
can
enough.
do it.
So the motion passes at least for the moment 3 out of the 4th. Manendra, your view?
Sorry, can you repeat that question?
The same question that SEBI says that if you are already invested over 50% of your AUM in just one stock, that's too much. We give you 6 months to bring it down below 50% or give us all the ultimate beneficial owners. Do you think 6 months are needed for you to find out your beneficial owners or to bring down your stake? Should you not be given much less time? The House believes, 3 persons believe that 2 months should suffice.
Yeah, I think SEBI is trying to give a staggered period of for people to think through if there is an ability to make the disclosures, which is the requirement that they are trying to come up with, or then over a period of 6 months, then you try and seek an exit and bring down your shareholding below 50%. Imagine a situation if it is a very short period also, then it will have some tremendous impact on the share market as well. I think SEBI trying to slow down the impact that, let's say, if any were to get out of
The stock market expert doesn't think there is an impact, huh? Deepak Shenoy. He's a very important person from the stock market. He doesn't think it's going to be disrupted, Manendra. So, I mean, I'm just wanting to know whether... So, basically, you don't support 2 months. You think they should be given more time. Is that your contention?
I think for any law to be implemented, and there is a reasonable expectation for any person to whom it is implemented, that there should be a reasonable time period for that person to be given to figure out the ways and means to be able to comply with some stringent norms. And this is a stringent norm which is being brought onto the book.
No, yeah, you know, you can agree with some parts. I mean, I take Vivek's and your point that a new fund needs to be given 6 months. But some other part of the consultation paper can always be, you know, objected to or improved upon or tweaked. Deepak, I thought you raised your hand. You wanted to say something about this 6-month period.
Yeah, I mean, actually, there is the period, you know, the way the rule is structured is any new FPI, whether they meet these norms or not, are also required to take, you know, an assurance from their own shareholders that they will, in case they breach these norms at some future date, they will also, they are empowered to, you know, SEBI is empowered to ask them about their granular details.
Yeah.
You know, and even if they are not in breach right now.
Yeah.
So I think that's also going to be a problem, whether the 2 months is in place or not for existing, the new ones will also get impacted.
No, yeah, but they, I think, are given some time, I think 10 days or something to bring down. If on a stray day you go above, they, it's not all that cast in stone. There is some elbow room. And maybe SEBI will extend it to even 15 days if people like you write to them saying that this could be cumbersome if you have to ask existing shareholders that in future, if I am in a violation, can I? That's a fair point, and maybe you should write to SEBI on that. See, my bigger point is, Vivek, okay, or let me put this to first, Mr. Loona. Do you think people may slip out of this by being able to create new funds or in some fashion having private agreements? And in the end, the SEBI consultation paper and final framework ends in giving a clean chit to the wrong people. Is that a possibility, Mr. Loona?
Yeah, I mean that if you give such a long period, then as I mentioned earlier also, then the intention of catching hold of people who have already committed violations of MPS requirement or press note number 3, then that possibility will be remote because you're given them a long time to comply with all this.
Okay.
So if there's a shorter period, then probably there's a possibility to catch hold of that.
That's a very important point. So, you know, the SEBI should not be so red in the face that it gives a clean chit to the wrong people. Very quickly, Vivek, I'm sorry I can't put it to everyone. Do you think it makes life difficult for the good guys?
See, reporting, etc. is tedious. So the 7-day reporting is extremely hard, and that's something which is going to be disruptive.
Okay. All right. So perhaps some changes to the 7-day reporting can, I mean, you could extend that a wee bit, perhaps. Yeah, I can understand for extremely large funds that will be tough. So perhaps different recommendations for the press note 3 guys and different recommendations for the minimum public shareholding. Right?
It talks about the UBO, you go right up to the individual who's there, so which is a difficult task.
Yeah, I take your point. Gentlemen, it was a pleasure speaking with you. This is just our kickoff for the discussion of a very important consultation paper. And at least we've got one thing which 3 out of 4 of you are telling SEBI, don't give 6 months, that's dangerously too long. You probably want to shorten it, but you may want to lengthen the other periods like 7-day reporting period in case you flout the law briefly. Take a point on that, and I hope SEBI is listening. Thank you very much for joining us in this very interesting conversation on the SEBI consultation paper. Thank you very much for watching. News and updates are lined up for you after a break.